If I were to offer to sell you a bank account with say $100,000 in it, how much would you be willing to pay me to acquire that bank account? Well, that might sound like a bit of a ridiculous thing to ask most people. Most people would probably answer something up to a hard limit of $100,000. Why would anyone ever pay more than $100,000 simply to acquire a bank account with $100,000 in it? Well, what if I told you that this particular bank account had a couple of unusual characteristics? Firstly, it earned 20% interest, substantially more than you'd find in most high yield savings accounts. And secondly, it would allow you to reinvest any interest earned in that account to keep compounding at 20% for the next, say, 15 years. If you were to reinvest your 20% interest each and every year for the next 15 years, that would be enough compounding to grow the account from $100,000 in year 1 to about $1.5 million by year 15. Well, that makes the equation far more interesting, and a budding investor might well be willing to pay a premium to that $100,000 currently sitting in the account because these special qualities would create enough wealth to justify a big premium. This might sound like an incredibly unrealistic scenario that someone would offer you this obscure bank account that earned a huge rate of interest, and frankly, if anyone ever does do that, just keep in mind that you're probably about to be scammed and you should be very, very cautious. But the same arithmetic actually applies almost directly to a lot of companies that have the opportunity to reinvest money at high rates for a long period of time. And investors regularly pay more than a company's balance sheet equity or its book value, the equivalent here to our $100,000 sitting in the account, in order to access a company's ability to reinvest at high rates and create wealth over a long period of time. Take a company like Chipotle Mexican Grill, for example, who over the past decade have a median return on equity of 22.7%. They've been able to plow their earnings back into opening new stores, and much like our high interest bank account, they've been able to earn very, very high rates of return on the company's equity. That has created massive amounts of equity for shareholders, but unfortunately for investors today, when we look at Chipotle, they currently trade for a massive about 18.5 times book value. That would be the equivalent of us paying about $1.8 million for our $100,000 bank account. Now, this sort of mental model for valuation is actually one I initially got from Roger Montgomery, an Australian-based value investor, and it's one that's been hugely valuable for me in the past year or so in identifying potentially very undervalued, high-quality companies. And in this video, I'd like to cover some of the finer details that you'll need to know to really take advantage of this type of thinking as an investor. So if you enjoy this video, be sure to subscribe to the channel if you haven't already, but without further ado, let's get straight into the video. Now, just as we've demonstrated in our bank account example, there is a relationship for good reason between a company's return on equity and the price to book value that investors would typically pay for that company in the market. Generally speaking, the higher the return on equity a company generates, the higher the price to book multiple investors will be willing to pay. It's not a perfect relationship, it's a loose relationship, but it is statistically significant. And there's multiple reasons that there's not a perfect relationship between return on equity and book value. Not every company's earnings and future return on equity is super predictable. And there's also a lot of companies that don't necessarily have the option to continue reinvesting at high rates of return. To demonstrate that, let's go through some more sort of hypothetical bank account examples. Firstly, let's take a pretty traditional savings account, and interest rates have come up a little bit recently. So let's say we're able to track down a bank account that can earn 5% interest. We invest $100,000 or put $100,000 into that bank account, and we let it compound at 5% a year for the next, say, 15 years. At the end of year 15, we would have a little over $200,000 in that 5% interest account, which we can then compare to a couple of our other options. Secondly, let's take another account, which in this case earns 20% interest, but unfortunately the bank isn't going to let us reinvest our interest payments. Instead, we're going to get these big fat dividend checks of about $20,000 each year on our initial $100,000 that went into the account. We can go and spend that and do whatever, but the account balance will always remain at $100,000 because that interest is always getting paid out to us for spending money, let's say. And thirdly, let's take our most magical bank account, which earns 20% interest and also allows for the complete reinvestment of any interest payments. And from year 0 to year 15, that would allow us to grow a $100,000 balance to a little over $1.5 million. Now let's put these 3 bank accounts up for sale to a group of reasonably intelligent investors who understand the concepts of intrinsic value. And let's say that they all want to earn about a 5% return. Now that's pretty simple. In our first basic, just standard 5% interest bank account, they would acquire our $100,000 account for exactly $100,000 and they would earn their 5% interest each year. Now our second example, which earns 20% interest but allows for absolutely no reinvestment, is actually also quite a straightforward calculation. Now in order for that $20,000 to be only a 5% return rather than 20% interest, investors would have to pay a substantial premium to the $100,000 currently sitting in the account. To be exact, they could pay 4 times the amount of cash currently sitting in the account and still earn a 5% return. So in this case, they would get $20,000 in interest on about a $400,000 investment. And assuming that we're never touching the principal in any of these accounts, that would allow them to capture a 5% return. And finally, in our spectacular 20% interest account where we can reinvest all of our annual interest payments, we could pay as much as $740,000 in order to get a 5% return over the next 15 years. The $100,000 in year 0 goes to about $1.5 million in year 15. And for that to be only a 5% return, we would have to pay about $740,000 to acquire the account. Our $740,000 would then turn into the $1.5 million sitting in the account at the end of year 15. So we can really justify quite a substantial premium here to the initial account balance because we know we're going to get a lot of interest built up over the next few years and it will justify that big fat initial price. Now what's really interesting here from an investment perspective is that if we were to switch all these bank accounts and instead think of them as companies, and instead of talking about interest payments we were talking about returns on equity, and instead of talking about the ability to reinvest our interest payments we were talking about reinvesting for growth in the business, then the maths and the wealth creation concepts here are actually really very similar. So with that in mind, let's look at 3 real-life companies that actually very closely resemble some of our bank account scenarios. The first company is a Warren Buffett investment and a pretty well-known company at that, and it's Kraft Heinz. Now, Kraft Heinz is an interesting company in the fact that it earns a very high return on tangible assets, similar in many ways to our return on equity discussion here. The unfortunate thing for Kraft Heinz is that it really doesn't have the ability to reinvest any capital at those high rates to continue growing. It's kind of similar to our 20% interest bank account where unfortunately we can't reinvest any of the interest payments. That's kind of the situation at Kraft Heinz. Kraft Heinz have a payout ratio which is right around 100%. They essentially earn a lot of cash each year and pay it all out as a dividend. And this is actually a clip around what Warren Buffett had to say on this exact topic.
Pointed out earlier, the company earns about $6 billion pre-tax, but after depreciation, not after amortization, but after depreciation, earns $6 billion on $7 billion of tangible assets. It's a fabulous business. It's in terms of return on tangible assets. I mean, this is a great business. We're sitting here at the Furniture Mart, but the return's much higher at Kraft. It's much higher than it is at J.P. Morgan. It's much. You go up and down the list. There's very few companies that are earning $6 billion on $7 billion of tangible assets. But we paid $100 billion more than the tangible assets in buying, and we overpaid in Kraft.
So although Kraft Heinz is a great business and earns a high return on tangible assets, what really matters here is actually the yield that you get on your purchase price. The return on equity is actually pretty much completely irrelevant because there is no opportunity for us as investors to put any more money to work at those high rates of return. Next, let's take a look at another Warren Buffett investment, in this case, Bank of America. Now, Bank of America is probably somewhere in the middle of our account that can't reinvest any money and our account that can reinvest all of its money. It's kind of somewhere in the middle here. And this is what Warren Buffett had to say on the ability for Bank of America to earn money on its tangible assets.
What do you think about banks? Not necessarily the sell-off today because you don't look at day by day.
Well, banking is a good business if you don't do dumb things on the asset side. I mean, basically, and it's a business that the banks we own earn between the commercial banks earn between 12% and 16% or so on net tangible assets. That's a good business. It's a fantastic business against the long-term bond, at 2%. If you have a choice between a 2% instrument and a 12% instrument, which one's going to win over time? So if you ask me whether I think banks are going to go down where they only earn 3 or 4% on tangible assets, I don't think that'll happen. The question is really whether they do something massively dumb. I mean, which periodically a number of banks have done. And I feel very good about the banks we own. They're very attractive compared to most other securities I see. And most of them are buying, Bank of America is buying in a lot of stock every year. So our ownership of the Bank of America this year probably will go up 7 or 8% without us spending a dime. I'd like to own any business, any good business where my ownership just goes up 7 or 8% every year without me spending any money, and on top of it I get a dividend and so on. They're very attractive, both against interest rates and against against bonds and against other stocks, in my view.
So Warren Buffett, one, likes Bank of America's ability to earn a high return on its tangible assets, and he also says that it's quite a bit more attractive than a lot of other securities that he looks at. Diving into some of the data around that, Bank of America pays out anywhere from about 20 to 30% of their annual earnings as a dividend. On top of that, they also put quite a bit of money towards share repurchases. So economically, at least, Bank of America is kind of like a bank account earning a 10% rate of interest, where you can reinvest, say, 70 or 80% of your annual interest payments. And for that reason, you could make a very strong argument that it justifies quite a significant premium to book value. And the reason I think why Warren Buffett said that it's quite attractive compared to many of the other securities that he looks at is that at the time of that interview, Bank of America was trading at a pretty modest premium to book. They were trading at right around 1.2 times book value. And finally, if we take a third business, let's go to Chipotle Mexican Grill, which is a real standout here. It's a type of company that has a long runway to reinvest basically all of its earnings into opening new stores, and it can continue to reinvest all of its earnings at very high rates of return, earning great returns on equity, kind of like our very weird bank account I shared at the start of this video. And for that reason, it probably justifies quite a premium to book value. Currently trades at about 18 times book value, which is an enormous premium. I'm not going to sit here and argue that it deserves that kind of premium, but nonetheless, investors clearly recognize Chipotle's ability to keep reinvesting and growing the underlying business. Now, of course, business results and future growth and return on equity is inherently much riskier and much less predictable than a bank account. But hopefully these ideas illustrate the point that a business that can reinvest a lot of money at high rates of return for a long time are very, very valuable for investors. You can find those kinds of businesses that have long runways for reinvestment at very high rates of return, and particularly if they don't trade at monster premiums to book value, then you potentially have a seriously good investment on your hands that you should look a lot more closely at. For me, if I can find the type of business that predominantly grows over time by increases in its tangible assets, things like banks or financial companies, real estate companies, any sort of company that needs to build new factories to keep growing, restaurant chains, anything that really grows through investment in new tangible assets. Pretty much the first things I really look at now are, number one, what's their return on equity? Secondly, how much of their annual earnings are they retaining and how much are they reinvesting? Thirdly, how long do I think they can reinvest at those types of rates? And fourth and final, what kind of price to book multiple do they trade at? If I can find one of these businesses that has a long runway for reinvestment and seems to be reinvesting at high returns on equity, say 15 or 20% or even more, and particularly if it trades at a pretty modest premium to book value, say somewhere in the 1 to 2 times book value range, that's a situation where I'm going to get very interested very quickly. And there's actually already a couple of those types of companies in my portfolio. Just like our 20% interest bank account that has the ability to reinvest those annual interest payments, those types of businesses can become very, very valuable over time, and they can justify a genuine premium to book value and still make sense as investments. So if you can find those types of companies trading at modest premiums to book, or even in a rare situation where they may be traded at a discount to book value, that is certainly worth a very close look. So I hope you enjoyed that video. That is a bit of a mental framework that I've picked up and found very useful in the past year or so. So I hope that helps some of you as well. If you did enjoy the video and you haven't subscribed to the channel already, please do. I would really appreciate that. But that's it from me for this video, and I'll see you on the next one. Cheers.